If you were born before 1970, the Social Security Administration is not playing by the same rules for you as it is for everyone else, and the mistakes being made right now, in 2026, are permanent. That word matters. Permanent. Not fixable next year. Not something you can appeal after the fact. The decisions people in your birth year are making today, or failing to make, are locking in numbers that will follow them for the rest of their lives. The SSA does not send you a letter when you are about to leave money on the table. They do not call you when a rule that applies specifically to your birth year is about to expire. They process your application. That is all they do. Whatever number you give them, they will pay you, even if that number is thousands of dollars less per year than you are actually entitled to. In this video, I'm going to break down the Social Security landscape by birth year group. Not because birth year is an interesting demographic detail, but because it is literally the variable that determines your full retirement age, your penalty rates, your claiming windows, and the specific mistakes that are quietly costing people in each group right now. Find your group. Stay until you get there, because the information in your specific section is not something the SSA website puts on the front page, and by the end of this video, you will know exactly what to check before you make any move. Before we get into the groups, let me explain why this channel exists. The Social Security Rulebook is over 2,700 pages long. The SSA updates it regularly. They do not notify you personally when a rule that affects your specific birth year changes. People who follow this channel find out about those changes in time to act on them. People who do not follow this channel often find out after they have already filed, when it is too late to undo the decision. If you're watching this and you have a parent or a sibling or a spouse who was born before 1970, send them this video. This is the kind of information that changes retirement income by hundreds of dollars a month. Now, let's get into the groups. Group 1. If you were born between 1943 and 1954, your full retirement age is 66 years and 0 months. You have already passed that threshold. And here is where I need to stop you from making the assumption that is quietly costing people in your group more money than any other mistake I see. The assumption is this: I already filed, so there is nothing left to check. That assumption is wrong. And in 2026, it is costing some people in this group over $400 a month they are fully entitled to. Here is the first thing to check. If you're married, widowed, or divorced after a marriage of 10 years or more, there's a survivor benefit or a spousal benefit calculation that may be significantly higher than the benefit you are currently receiving. The SSA will not automatically switch you to the higher amount in every scenario. There are specific circumstances where you need to request the recalculation or initiate the switch yourself. If your spouse had a higher earning record than you, and you have not had a benefits review since they passed or since their own benefit increased, you may be leaving real money uncollected right now. The second thing people in this group consistently overlook is the Medicare income-related monthly adjustment amount, the IRMA surcharge. If your income in 2023 or 2024 was elevated due to a one-time event, a property sale, a retirement account distribution, a business transaction, you may be paying a Medicare premium surcharge in 2026 that you are legally entitled to appeal and remove. The SSA bases your IRMA on a 2-year look-back. A one-time income spike 2 years ago should not permanently inflate your Medicare cost. But if you do not file the appeal, specifically Form SSA 44, they will keep charging you. This is not complicated. It is a form and a letter of explanation. People in your group are paying an extra $90 to over $300 per month on their Medicare premium when they do not have to. If you're in the 1943 to 1954 group and you have not done a benefits review in the last 12 months, that review is the single most valuable hour you will spend this year. Group 2. If you were born between 1955 and 1959, this is the highest urgency group in this video. I'm going to say that plainly, and I'm going to explain exactly why. Your full retirement age is not a single number. It is not 66. It depends on your exact birth year within this range, and the difference between getting this right and getting it wrong is not minor. For people born in 1955, your FRA is 66 years and 2 months. For 1956, it is 66 and 4 months. For 1957, 66 and 6 months. For 1958, 66 and 8 months. For 1959, 66, and 10 months. Here is why those 2-month increments matter more than you might think. Every month you claim before your specific FRA, your benefit is permanently reduced. Not for a year, not until you reach FRA. Permanently, for the rest of your life. The reduction rate is 0.5% per month for the first 36 months before FRA, and 0.5% for each additional month before that. Run those numbers on an average benefit in a 12-month miscalculation, claiming at what you thought was your FRA, but was actually 1 year early, and you're looking at a reduction of roughly 6 to 7%. On a benefit of $1,800 a month, that is between $108 and $126 gone every single month. Over 20 years, that is between $25,000 and $30,000. But that is the conservative scenario. If you have already claimed and you are in this group, there is a second calculation that matters enormously right now. Delayed retirement credits. If you have not yet filed and you're under 70 years old, every month you delay past your FRA earns you 0.2% more per month. That is 8% per year. If your benefit at FRA would be $2,000 per month and you delay to age 70, your monthly benefit becomes approximately $2,640. The difference is $640 per month. Over 20 years, that is $153,600. The SSA will not call you at your FRA and remind you that the clock is ticking on your delayed credits window. They're not going to explain that every month you wait past 70 earns you nothing additional. If you're in a 1955 to 1959 group and you have not yet filed, you are sitting at the most consequential decision window of your retirement, and you need to make it based on accurate math, not guesswork. One more thing for this group, the earnings test. If you claimed early and you are still working, the SSA withhold a portion of your benefit for every dollar you earn above a specific threshold. In 2026, that threshold is around $22,320. For every $2 you earn above that, they withhold $1 of benefits. This is not a penalty. When you reach FRA, they recalculate your benefit upward to credit those withheld months. But if you do not understand the mechanics, it creates confusion and sometimes leads people to stop working unnecessarily, which has its own long-term income consequences. Know what is happening with your specific numbers. Group 3. If you were born between 1960 and 1964, your full retirement age is 67. That is the latest FRA threshold in the current Social Security framework for anyone born before 1970. And your group carries one of the most aggressive early claiming penalty structures in the system. If you claim at 62, the earliest possible age, you are looking at a permanent reduction of 30%. Not 5%, not 10, 30. On a projected benefit of $2,200 per month at FRA. Claiming at 62 means you receive $1,540 every month for life. The difference is $660 per month. Over a 20-year retirement, that is $158,400 left on the table. I want to stop here and address the argument some people in this group make, that claiming early makes sense because you collect more checks. It is a reasonable sounding argument, and it is usually wrong. The break-even point, the age at which the cumulative value of waiting overtakes the cumulative value of early claiming, is typically in the late 70s. If you have any family history of longevity, if you're in good health at 62, and if you have other income sources that can bridge the gap, the math of waiting almost always wins. But here is the thing almost nobody in your group is talking about in 2026. The retroactive lump sum option. If you have already reached your FRA and you have not yet filed, you can request up to 6 months of retroactive benefits as a lump sum payment when you do file. The SSA will treat your application as if you filed 6 months earlier, and they will pay you the back amount in a single check. Almost nobody asks for this. The SSA does not put it in their promotional materials. It is a legitimate option under SSA rules for people who have passed their FRA and want a cash infusion at the time of filing without permanently changing their benefit rate in a meaningful way. If your FRA is this year, or if you passed it recently and have been delaying, this is worth a direct conversation with an SSA representative or with a Social Security claiming specialist before you file. The other action item for this group right now is your earnings record. Go to ssa.gov and create or log into your My Social Security account. Pull your full earnings history. Look at every year on that record. Social Security calculates your benefit using your highest 35 years of earnings. If there's a year that shows 0 when you were actually working, or a year that shows a lower number than you earned, that error is reducing your benefit. Employers make reporting mistakes. Self-employment income sometimes gets misapplied. These errors are correctable, but the correction window has limits and the process requires documentation. If you wait until you're already in the claiming process to discover a 10-year-old earnings error, fixing it becomes significantly harder and sometimes impossible. Check your record now, while you still have time to correct it. Group 4. If you were born between 1965 and 1969, you are likely the group most tempted to skip this section. You are thinking, I am not claiming for years. This does not apply to me yet. I will look into this later. That thinking is exactly why I saved your group for last. Because what I am about to tell you is not about what you should do when you turn 62. It is about what is happening to your benefit right now and what window is quietly closing. First, your full retirement age is also 67. You share that with the 1960 to 1964 group. Your delayed retirement credit window runs from 67 to 70, just like theirs. The 8% per year delayed credit math applies to you too. But unlike every other group in this video, you have something they do not. You have time to make the earnings record corrections that will determine your baseline benefit number. And the time to make those corrections is not unlimited. Here is why this matters urgently in 2026. The Social Security Administration can only correct earnings record errors going back a certain number of years under standard procedures. Older errors require more documentation and sometimes involve employer records that no longer exist, former business entities that have closed, or tax records that have been purged. If you had a period of self-employment, contract work, or a job where you were paid in cash, particularly in the 1990s or early 2000s, the probability that something on your earnings record is inaccurate is higher than you think. A single missing year of income near your peak earnings years does not just reduce your benefit by the proportional value of that year. Remember, SSA uses your highest 35 years. If that missing year would have displaced a lower earning year from your top 35, the impact compounds. A $5,000 error in a peak earning year could reduce your monthly benefit by $30 to $50 or more. Over a 20-year retirement, that is between $7,200 and $12,000. Right now, not in 5 years, not when you turn 60, is the easiest and most documentation-friendly time to correct those errors. Go to My Social Security. Download your earnings record as a PDF. Compare it year by year against your tax returns or W-2s. Flag every discrepancy. Then call the SSA. The number is 1-800-772-1213 and initiate a correction request. Bring documentation. Be specific about the year and the employer. The second thing your group needs to understand is the spousal and divorce benefit architecture. If you are married, your lifetime benefit strategy is not just about your own record. It is about the combination of your record and your spouse's record and the sequence in which you claim. Getting that sequence wrong can cost a household tens of thousands of dollars over a joint retirement. This is not a one-size-fits-all calculation. It depends on the income gap between spouses, health history, and asset availability. But the time to model those scenarios, using actual projected benefit numbers from your My Social Security account, is now. Not at 62, not at 66. Now, because some coordination strategies require decisions made years before you file. If you're in a 1965 to 1969 group and you do not have a My Social Security account, creating one tonight is the single most financially productive hour you will spend this month. Let me bring this together. If you were born between 1943 and 1954, the action for you is a benefits review, specifically checking spousal or survivor benefit entitlements and the IRMA surcharge appeal if a one-time income event affected your Medicare premiums in the last 2 years. If you were born between 1955 and 1959, the action is knowing your exact FRA down to the month, running the delayed credits math against your actual projected benefit, and understanding the earnings test if you are still working. If you were born between 1960 and 1964, the action is calculating the true 30-year cost of early claiming before you make any move, asking about the 6-month retroactive lump sum option at or after FRA, and auditing your earnings record now. If you were born between 1965 and 1969, the action is auditing your earnings record now, while corrections are still straightforward and starting to model household claiming sequence strategies with real numbers from your SSA account. None of these things require a financial advisor, though having one who specializes in Social Security optimization is valuable. All of them require that you know your specific situation, your specific birth year rules, and your specific numbers. The SSA is not going to explain the gap between what you are entitled to and what you are about to claim. That is not their job. Their job is to process the application you hand them. Your job, starting today, is to make sure that application reflects everything you have earned. If this video helped you or someone in your family, share it. Not as a courtesy. Share it because the person in your life who is closest to claiming and has not done this research is the person most at risk of making a permanent mistake in the next 12 months. They may not find this on their own. You sending it to them is the reason content like this exists. Subscribe to this channel if you want to know when the SSA changes rules that affect your birth year group, because they will, and they will not be sending you a letter about it.